Silver didn't rally, it repriced, and the market can't quietly put it back in the box now. Not with silver printing triple digits, not with the dollar sliding at the same time yields are rising, and not with the kind of market plumbing stress that only shows up when the tape is being pulled by math, not mood. Because the mainstream story is already trying to tidy this up into a neat little headline: weak dollar, metals up. Convenient, comforting, and incomplete. The real battle is happening underneath the headline, where collateral rules, dealer hedging, and the curve decide who gets to stay in the trade and who gets tossed out by force. And later in this video, I am going to give you the one zone that matters most for the next week or two, because if that level breaks, the math changes and the entire silver setup flips from healthy pullback to forced continuation. Here is the uncomfortable part. The phrase yields are rising is not automatically bearish for metals. It depends on why yields are rising. Are they rising because growth is booming and real rates are tightening into strength? Or are they rising because the bond market is asking for a bigger trust premium, a bigger term premium, a bigger cushion for holding long duration in a world that feels less stable than the models want to admit? Those are two totally different animals. In the first world, precious metals often struggle. In the second world, metals can rip while yields rise because it's not about opportunity cost anymore. It's about credibility. It's about hedging a system that's getting noisier. And that's why you can have the seemingly impossible combo. Dollar down, yields up, silver exploding. That's not a clean risk-on signal. That's a confidence fracture signal. And that's where the real pressure starts. Now zoom out for 1 second and really look at what silver just did. When a market goes from fighting overhead resistance to printing a new regime high in the same month, it's not a normal trend. It's a positioning event. It's a market discovering that supply of liquidity at those prices is thinner than people assumed. It's the kind of move where you don't just ask, well, why did it go up? You ask who got forced to buy, who couldn't sell anymore, and what mechanism turned normal buying into a vertical candle. Because if you treat this like a cute momentum story, you'll miss the actual driver. And the driver is always the same in these violent phases: constraints. Constraints on inventory, constraints on hedging, constraints on collateral, constraints on time. Let's kill the lazy narrative quickly. Yes, a weaker dollar can mechanically support commodity prices because it changes the effective price for non-dollar buyers, and it shifts relative valuations. Fine. But the real question is why the dollar is weakening while yields are rising. That's the tell. That's the part that matters. Because when the currency softens, even as nominal yields climb, it can signal that foreign demand for the bond complex is not as eager at current terms, or that the market is demanding a higher yield to compensate for uncertainty. That doesn't mean collapse. It doesn't mean doom. It means the system has to pay up for funding. And when funding gets a little more expensive and a little more fragile, the desire to own something outside that funding chain increases. Silver sits right on that fault line because it is both a monetary metal and an industrial input. It's a hedge and a raw material. It trades like a chameleon, and that's exactly why its moves can be so violent. And the next detail is what flips the whole setup. Because the hidden detail most people missed isn't a rumor. It isn't a shadowy villain. It's boring. It's mechanical. It's risk management. As silver accelerated, the exchange S margin framework effectively made it more expensive to be on the wrong side of the move at the worst possible time. And you need to understand what that means in plain English. If you re-short silver futures, you don't just wait it out when price goes vertical. Your broker demands more collateral. Your clearing member demands more collateral. Your risk desk tightens limits. And if margin requirements rise as a percentage of notional during violent swings, the collateral call grows faster than people expect. That turns, I'll just hold my short, into I need to reduce this short, or I am going to get liquidated. It doesn't require anyone to be evil. It just requires the rules of survival to tighten. And when that happens, short positions stop being opinions and start being liabilities. That's where forced buying begins. And that's not the part that matters most yet. The part that matters is what forced buying does to price discovery when liquidity thins. Futures markets are designed to absorb flow, but they're not magical. When volatility spikes, spreads widen, dealers pull size, and the order book becomes a lot more fragile than the chart makes it look. So when you get a wave of buy-to-cover orders, not I would like to buy, but I must buy, the market can gap through levels that normally act like walls. That's why breakout phases feel unreal. It's not that everyone suddenly fell in love with silver. It's that the market found out where the weak hands were, where the leverage was concentrated, and where the collateral constraints would force behavior. Behavior is everything. Prices don't move because people believe. They move because people must. Now layer in the second accelerant, options reflexivity. This is where a normal breakout becomes a melt-up. If you've ever watched a market move up in a straight line and wondered, who is buying up here? This makes no sense. The answer is often dealers hedging. Here's the clean version. When traders buy calls, someone sells those calls. Often that someone is a dealer. Dealers don't want directional exposure, so they hedge the delta, meaning they buy the underlying as the call's sensitivity increases. And gamma measures how quickly that delta changes as price moves. When price rises into a dense band of call strikes, the dealer's hedge requirement can increase rapidly. That's when the dealer goes from being a liquidity provider to being an involuntary buyer. They chase the market higher because the math makes them. That's not conspiracy, that's structure. And when you combine that with shorts being squeezed by margin pressure, you get a feedback loop. Higher price forces more buying, which forces higher price. This is reflexivity. It's the market turning its own risk management into fuel. And that's where it gets dangerous, because reflexive moves don't end politely. So if you want to know whether this is real or fake, stop arguing about vibes. Interrogate the curve. The term structure is your lie detector. In simple terms, if near-dated prices are elevated relative to later-dated prices, if the front end is tight, if spreads are screaming, that can be a signal of immediate demand, immediate stress, or immediate hedging pressure. Backwardation is often a sign that the market values the commodity now more than later. Contango can suggest ease of carry, storage costs, and comfortable supply. It's not perfect. It doesn't predict the future like a crystal ball, but it tells you how the market is pricing time. And time is the enemy in leveraged markets. When the front end tightens, it's a signal that now is expensive. And when now becomes expensive, every participant has to adjust. Producers rethink hedges, consumers rethink coverage, arbitrage desks watch the basis, and speculators realize the carry trade isn't a free lunch. But that's not the only proof point. Next, inventories. This is where people mess up because they treat inventory numbers like gospel. They're not. Inventories are messy. There are categories. There are deliverable versus non-deliverable stocks. There's metal sitting in a vault that isn't T-economically available at current prices because of ownership constraints or logistical friction. And there can be timing issues and reporting limitations. Still, inventories matter because they are the most visible thermostat the market has. When price surges and inventories are not obviously ballooning, it tells you supply isn't rushing in to crush the move. When price surges and deliverable categories are watched closely, it tells you the market is sensitive to the idea of tightness. You don't need a dramatic shortage narrative to respect that sensitivity. You just need to understand that in a leveraged market, perception of tightness can be enough to keep the bid aggressive, because nobody wants to be the short who gets trapped into delivery dynamics or into a basis blowout. And that's where the real pressure starts. Now let's talk supply chain reality, because this is where silver is different from the just print more world. Silver supply doesn't respond instantly to price. A big chunk of silver production is byproduct from mining other metals. That means even if silver price goes bananas, it doesn't automatically flip a switch and create new primary supply next week. Mine planning and refining capacity live on long lead times. Permitting is slow, capex is slow, even recycling, which can respond faster than mining, has limits. You can't recycle what isn't being scrapped. You can't refine what isn't being collected. And logistics are not frictionless. So higher prices can ration demand and pull in marginal supply over time, but in the near term, they mostly do one thing. They change behavior. They make industrial users more defensive. They make procurement more urgent. They make hedging programs rethink how much coverage is enough. And they make the paper market more sensitive to any hint of physical stress. That doesn't mean silver is gone. It means the near-term elasticity is limited. And limited elasticity is exactly what produces violent price discovery when flows hit. Industrial demand is the other half of the story people either overhype or dismiss. Here's the balanced view. Industrial demand is real, but it doesn't surge overnight on a whim. What changes quickly is procurement behavior. When price starts acting like it can run away, industrial buyers don't want to be caught undercovered. They don't want to explain to management why a key input suddenly costs far more or why a supply chain got disrupted. So they can shift from I'll buy as needed to we're going to lock in coverage. That's not panic, it's operational risk management. And when enough real-world buyers lean that way at the same time speculators are chasing, the market feels like it's being squeezed from both sides. Paper reflexivity on top, physical defensiveness underneath. That's the kind of blend that makes silver uniquely explosive. And the next detail is what flips the whole setup. Let's add institutional flows and positioning, because markets are not made of retail and smart money. They're made of mandates. When a market breaks into a new high regime, funds with trend-following rules can become buyers. Funds that were underweight may rebalance. Risk parity style frameworks can adjust. Meanwhile, if short positioning was crowded, whether from hedgers, spread traders, or macro skeptics, a sharp move can force them to reduce. Again, must, not want. That's why these moves feel unfair. Because they are. Not morally unfair. Mechanically unfair. The rules punish the side that needs more time, and shorts always need more time than a rising market is willing to grant. Now, why did yields rising not kill this? Because the market is not pricing higher yields in isolation, it's pricing the reason behind them. If yields rise because inflation expectations are sticky, because fiscal issuance is heavy, because global buyers demand better compensation, or because volatility and duration increases, then the bond market can be sending a signal of stress rather than strength. And in that environment, a weakening dollar can amplify the bid for hard assets. Think of it like this. If both the currency and the long bond are sending not as stable as you thought vibes at the same time, the demand for alternatives rises. Gold often gets the first wave. Silver, because it's thinner and more volatile, can get the second wave in a way that looks like a slingshot. And that's where the real pressure starts. Now let's talk calendar, because why now is never just philosophical. This week is wired for volatility. You've got thin liquidity pockets that show up around weekends. You've got month-end dynamics where funds rebalance, and you've got central bank risk sitting right on the calendar. When a major policy event is imminent, dealers and leveraged players down a T want to be caught with the wrong exposure into a headline risk moment. So they de-risk. But de-risking doesn't mean selling in an orderly fashion. It can mean buying back shorts before the event. It can mean closing option structures. It can mean widening hedges. And when that happens in a market that's already moving fast, the act of reducing risk can add to the move. That's the paradox. The calendar can be the catalyst even if nothing new happens, because the timeline forces actions. And if you're watching silver and thinking, this feels like it's getting ahead of itself, remember, markets often get ahead of themselves precisely because the calendar compresses decision-making. Here's where viewers usually get trapped. They confuse trend signal with noise. In a squeeze-like phase, the market will whip around violently, even if the broader thesis is correct. That's not a flaw, that's the mechanism. Volatility is how the market tests conviction and harvests liquidity. It runs stops, it reverses hard. It prints scary candles that look like the end, then turns around and rips again. And if you don't have a framework, you'll become the liquidity. That's the psychology shield you need right now. The market's next job is to make you emotionally wrong. If you buy, it will try to scare you out. If you short, it will try to humiliate you. If you hesitate, it will try to lure you into chasing at the worst possible moment. The antidote is simple but not easy. Separate the signal from the noise by watching the plumbing, not just the price. So what do you watch? You watch whether pullbacks are shallow or deep. You watch whether dips get bought quickly or whether they linger. You watch the curve. Does the front end stay tight or does it relax? You watch spreads and liquidity. Are moves happening with widening gaps and thin books or with controlled flow? You watch implied volatility. Is it rising with price in a way that signals stress or collapsing in a way that signals the move is losing fuel? You watch for signs of forced behavior, sharp, sudden moves into the close, outsized gaps, and relentless trend days where the tape feels one way. And you watch the dollar and yields together, not separately, because that combo is the macro fingerprint of this regime. Because if that fingerprint changes, the odds change. And that's where the real pressure starts. Now let's make this concrete with a near-term roadmap, because this is what everyone actually cares about. What happens next week, what level matters, and what would invalidate the thesis. I'm going to give you a two-scenario lens, because pretending there's only one path is how people blow themselves up. Scenario one is the controlled pullback and retest. In this scenario, silver cools off from the vertical move. Maybe it dips back toward the breakout zone and it tries to build a higher base. The tape gets choppy. Headlines get loud. People declare it over. This is where the market tries to shake out late longs and tempt shorts back in. The confirmation signal for this scenario is not it went down. Pullbacks are normal. The confirmation is whether the market holds that breakout shelf on a closing basis and whether dips are met with real buying. If that shelf holds and the curve stays relatively tight, it tells you the move is consolidating, not collapsing. It tells you the market is digesting higher prices. And if that happens into month end and into policy risk, it sets up the next leg higher, because the market has had time to reset positioning without resetting the regime. Scenario two is the continuation squeeze. This is the dangerous one. In this scenario, silver doesn't give you the polite pullback. It stays bid, it keeps pressing, and it forces more hedging and more short covering. The tell here is acceleration without relief. Successive pushes where pullbacks get instantly swallowed, where the market refuses to fill gaps, where volatility stays elevated, and where the every dip is bought behavior becomes obvious. This scenario carries gap risk. It can overshoot, it can look euphoric, and then it can punish late chasers with brutal snapbacks. But it's not random. It's reflexivity. It's dealers hedging into calls, shorts buying to survive, and liquidity thinning as everyone tries to adjust at the same time. So what level matters? Conceptually, it is the breakout shelf, the zone the market fought through before it printed these new highs. That's the line in the sand for trend signal versus noise. If price revisits that zone and holds, the move is being validated. If price slices through it cleanly and stays below it, and the curve relaxes at the same time, and volatility collapses, that's the market telling you the squeeze fuel is fading. That doesn't mean silver is dead forever. It means this phase of the move is likely pausing or retracing more deeply. And you need that distinction because it keeps you from turning a trade idea into a belief system. The next detail is what flips the whole setup. It's not the level itself, it's how the market behaves around it. And let's zoom back to proof stacking, because trust comes from layers, not from one hot take. Layer 1, market structure and collateral. Rising margin pressure in a fast move forces behavior. Layer 2, options reflexivity. Dealer hedging can turn an upside breakout into a self-feeding rally. Layer 3, the curve. Tight front-end pricing signals immediate demand for exposure and stress in time. Layer 4, supply chain elasticity. Byproduct constraints and refining logistics mean supply can't instantly flood the market to cap price. Layer 5, demand behavior. Industrial buyers can shift procurement defensively when price threatens runaway risk. Layer 6, bonus, macro fingerprint. Dollar weakening alongside rising yields hints at credibility to match our term premium dynamics that support hard asset bids. Any one of these can be wrong. All of them together create a setup you don't dismiss with a shrug. And now the counterpoints, because if you can't articulate the bear case, you don't have a thesis, you have a crush. Counterpoint 1, a sharp move can be mostly positioning and could mean revert violently once the forced buyers are done. That's real. Counterpoint 2, if yields rise because real rates strengthen and the dollar stabilizes, the macro support can fade. Counterpoint 3, if volatility spikes too far, exchanges and brokers can tighten risk even more, which can force liquidation on both sides and create chaotic swings. Counterpoint 4, if industrial demand doesn't or follow through and physical premiums done to reflect tightness, the story can cool. None of that requires panic. It requires awareness. Because if you know what can break the thesis, you stop being emotionally manipulated by price. Let's talk manipulation without doing the cartoon version. Do big players try to shape narratives? Sure. Do institutions manage optics? Always. But you don't need to allege secret meetings to explain what's happening. The incentives are enough. When a market breaks out, people who were positioned the other way want you to believe the move is irrational, so you'll hesitate. When a market is volatile, media wants a clean headline every day. So they'll ping-pong from silver is unstoppable to silver is crashing on the same underlying trend. And when price is whipping around, your brain wants certainty, so it will latch onto whatever explains the last candle. That's how volatility is used against you. Not by mind control, but by exploiting your need for narrative. The cure is to anchor yourself to mechanisms. What forces participants to do? What matters this week? What changes price discovery? What to watch next? So here's what to watch over the next 1 to 2 weeks if you want to stay on the right side of the math. Watch the dollar and long yields together. If the dollar keeps bleeding while yields remain firm, the macro mix can keep hard asset demand supported. Watch the reaction around the breakout shelf. If it holds on pullbacks, it's constructive. Watch the curve and spreads. If near-term tightness persists, it suggests the market still values immediate exposure. Watch volatility. If implied vol stays bid, the market is telling you stress remains. If vol collapses while price stalls, it can mean the reflexive fuel is burning out. Watch for calendar-driven flow into month-end and into policy risk. Funds don't care about your feelings, they care about their mandates. And when mandates shift, flows move. And one more thing, do not underestimate how quickly silver can go from this is the trade of the year to why is everyone silent? Silver is famous for punishing certainty. It can rally like a mania and then retrace like a trap, even if the big picture remains bullish. That's why the most dangerous emotion in markets is not fear, it's being sure. Use the two-scenario lens. If we get a controlled pullback, respect it and watch for stabilization. If we get continuation squeeze behavior, respect the gap risk and don't pretend you can time every tick. The goal isn't to feel smart every day. The goal is to avoid being the liquidity for someone else's risk management. Now, if you're still here, you're already doing the thing most people refuse to do. You're rid watching the plumbing, not just the price. That is the whole edge for retail investors who want to think like pros without pretending they re-insiders. Keep that identity. Be the person who asks, what forces the trade? Be the person who watches the curve and the calendar. Be the person who knows what would invalidate the thesis before the market tries to teach it the hard way. And if you want to stay plugged into this kind of mechanism-first breakdown, not hype, not doom, just clean cause and effect, stick with the community and keep comparing notes because in a market like this, the biggest advantage isn't secret information, it's disciplined interpretation. Silver has announced itself. The market can't unsee it. The only question now is whether it digests the move with a controlled retest or whether the reflexive engine stays lit long enough to force a continuation squeeze. Either way, the next week is where the real information arrives, because this is when the calendar, the collateral, and the options positioning collide. Watch the shelf, watch the curve, watch the macro fingerprint, and don't let the volatility rent space in your head for free.